All right. Welcome. This is how to analyze a passive investment. So like I said, this is geared towards the passive investor. When you're looking at a deal, how do you know that it's a quality opportunity? What are the things you want to look for? What are the things you want to avoid? What are the red flags? What are the things that should make you have that warm fuzzy inside that you're on the right track, right? So that's what the intent behind this is. So without further ado, we'll go ahead and get into it. So a couple housekeeping items first. So of course, at the end, we're going to have a Q&A. So keep track of questions as we go along and we can have a nice discussion at the end. Of course, always do your own due diligence. A lot of this is my own opinion, my own philosophies around investing and multifamily as an asset class. So of course, seek your own counsel, have your own consiglieres out there that you work with. Nothing here should be interpreted as an offering. I have no offerings available right now, and those can only come from a private placement memorandum. And then, of course, the replay will be sent out usually within 24 to 48 hours, depending on if I have to do anything in post. So, all right. All right, here's the agenda. So we'll start off, we'll just do a super brief intro to multifamily. The purpose of this isn't really to teach you everything about multifamily as an asset class. If you're looking for that material, I have Mastering the Art of Multifamily Fundamentals on my YouTube channel, so you can go check that out. And that does a deep dive into multifamily as an asset class. You can check that out. Then we're going to go over kind of what the first steps are when you're looking for a deal. What are the red flags you want to avoid? What should your expectations be? What's a return that you can expect to receive from a multifamily investment? And then we'll look at some of my kind of primary insights that I look at, the chief things that I look at to kind of gauge an operator, and then of course the Q&A. All right, a bit about myself there. I know there's some people on the call that are unfamiliar with me. So a little background about myself. I'm originally from the Boston area. Out of college, I had an ROTC scholarship, so I went right into active duty Air Force. I had a flying spot, so I went and eventually flew the B-1 bomber. So I did that active duty for 8 years. And that was actually when I got my first investment property. I got stationed up in Rapid City, South Dakota, and I was tired of renting, so I wanted to buy a place. I got a duplex. Didn't know a thing about rental investing. I just kind of did some back of the napkin math and, it kind of worked out. So a couple of years later, I got another duplex. A couple of years later, I got another duplex and so on. So when I left the Air Force, I had these cash flowing rentals kicking off profit. And I liked it. It was fulfilling to see a property turn around and get some nice tenants in there, people that appreciated living there. So, there's some personal fulfillment there, right? I enjoyed it. So that led me down the path to being a full-time real estate investor, which is what I focus on now with Mach 1 Equity, is the company I founded last year. So we have a couple deals that we did last year. I'm looking to 2021 to have a banner year. So I'm excited. Also a big crypto guy. So I invested in Bitcoin in 2013, back when everyone was laughing, and now we're sitting at 50K and Elon Musk is on board. So pretty pleased with that. All right, here's a look at just a couple of my active projects. So the one on the right that was my first syndication. So that was a medical office development out in Loveland, Colorado with my partner out there, the builder. We're building it's an 8,500 square foot medical office. We expect construction to complete around May. So we'll be ready for a summer sale. And then on the left there, the most recent acquisition, that's Glen Oaks Apartments located in Houston. And that's a great 232 unit apartment complex that I bought along with some sponsors and our investors. And that's a solid value add play, great management opportunities, a lot of opportunities to add value through renovations and landscaping, things like that. So really excited about that. That one should close in about 2 weeks. We were supposed to close last week, but we had some delays due to the Texas storm burst a few pipes. So it slowed down our closing a little bit, but hey, that's kind of the real estate, right? Sometimes those things happen when you're going through those closing processes. So, all right. So why multifamily? Why do we even like this as an asset class? So why is it so preferred? Well, the big thing is it's safe and stable. The safety and stability you get from real estate really is unmatched by any other asset class. I mean, you don't have the volatility that you see in the equities and the stock markets. You're not having these wild swings. It's pretty steady eddy. Also, it's a great source of passive income. So if you need income in retirement, for example, you can put your retirement funds in cash flowing real estate and you can live off that in retirement. It's a lot of people's plan and it works great. Or just, if you're younger and you want it to supplement your lifestyle, or use that to further invest, compound your gains, then that's a great method as well. The tax benefits, tax bennies, everyone wants to give the old stiff arm to Uncle Sam, right? So there's great tax opportunities, tax saving opportunities in real estate. There's bonus depreciation, where we go in, we do what's called a cost segregation study. So the first year you get to write off 15 years of depreciation. So that's a great opportunity to shelter yourself. That's something I took advantage of with the Houston property. I actually cast in a couple $100,000 in Bitcoin, which would have left me with a huge capital gains burden. But because of the cost segregation, I'm able to write off a lot of that. So great technique there to move asset classes, or 1031 exchange as well as a way to defer capital gains. When you sell a property, you put the money right back into another property. Of course, right now we're experiencing record low interest rates, so it's a great time to take on fixed rate long-term debt, which allows you to leverage your money. We'll talk a little bit more about that later slide, I think, but also your time. And I think that probably doesn't get talked about enough, but the ability to put your money into a passive investment and just collect checks every quarter and not have to spend any time worrying about it, I think really is a huge benefit. And then of course the inflation hedge as well. So right now the money printer is spitting out, I think they printed 25% of the total M2 money supply last year. So inflation is a big concern right now with investors. So that real estate's a great hedge against that. And it's performed really well. I mean, throughout the pandemic, rent collections have been stable, largely negligible losses. And just overall, it's really proven its resiliency, right? So we expect rent growth to resume in 2021. So great asset, great performing. And that's why it really is, as a sector, it's been the darling of those looking for income producing assets. So nice little quote there. I pulled that slide from my 2021 market forecast that I did last month. So if you're looking for a 2021 market forecast, you can check that out on my YouTube channel as well. All right, so I've convinced you. You're like, Keegan, I got it. I want to invest in real estate, but where do I start? What do I need to know? All right, so first, some brief intro to some terms. This is kind of all I'm going to go, and then we'll dive into the meat and potatoes. So you want to know who are the players. So you're going to hear these terms: GP, that stands for general partnership. That's the operator, that's the sponsor, that's the lead on the deal, right? So usually it's a team of people that make up the general partnership. Usually it's a few people that are working together to take down these assets. But that's one side of the deal. Those are the decision makers. Those are the managers of the deal, the general partnership. On the other end of that, you have the limited partners. So the limited partnership, that's your investors, sometimes referred to as partners. So those are the people that are investing money into the deal. And in return, they have an equity share. So they're actually partners in the deal. They actually own a share of the real estate, right? So really cool opportunity. And usually those are broken up into two classes. You have accredited, which are anybody with a net worth over $1 million, not including your primary home, or making over $200,000 a year. So that's a basic definition of that. Sophisticated investors, so those that don't qualify for the accredited label, being sophisticated basically just means you know the risks of real estate, you understand it as an asset class, you know what you're getting into, right? So you still generally have to have a certain level of net worth and liquidity that your sponsor's going to want to know, and they're not going to want to take your last $50,000, right? But it's, how do you become sophisticated? There's no like certificate you got to get. You do a couple webinars like this, you talk to some sponsors, and you're sophisticated, right? So it's pretty easy. Some of the terms, the lingo that you got to know. So cash flow, this is a big one. That's the one everyone loves, right? Cash flow. So that's just your yearly profits from the rent. So after you collect your rent, you pay off all your expenses. What's left is the net operating income. I'll explain that in a second. And then you pay off your debt obligations, and everything that's left over, that's your profit, that's your cash flow. That's what we call it. So every year, if you invested, say, $100,000 into a project and you received $2,000 a quarter, so you got $8,000 that year, you would receive an 8% cash on cash return. That's your cash flow, 8% a year. So in line with that net operating income, that's a step prior. So once you take your gross rents and you subtract your operating expenses, it leaves you with your net operating income, which we always want to know when we're evaluating property, because everyone's debt situation is different. So that's why it doesn't account for debt, because that could be anything, right? So pro forma. What's a pro forma? It's just a projection. It's your projected profit and loss statement, right? So usually you're going to see a pro forma out to 5 years, maybe 10 years. And it's just, here's the projection of the financials for the property. The pref, the preferred return. I put pref there just to save room, but that's what the cool kids call it. So call it the pref. So the pref is, what it is let's say you have an 8 pref. They call it 8 pref. Means as an investor, you're entitled to the first 8% of profits before the GP receives any share of those profits, right? So you have to get an 8% return before the GP can collect any profits, okay? So if it's a 6 pref, you get everything up until 6%, and then after that, the split occurs, right? IRR, so this is internal rate of return. So it's similar to, it's kind of a way to look at annualized return, but taking into account the time value of money. So if you have 2 investments that you're comparing, and they're both, say they're both a 5-year timeline, but one is a development deal, so you have no cash flow, and the other is an apartment complex that's already built and it's cash flowing. Typically, if they have the same total return, the IRR on the cash flowing property is going to be higher, because it assumes in the equation that you can reinvest your cash flow to basically compound your returns, right? So that's what IRR. So it's helpful sometimes when you're comparing 2 different investment opportunities. The PPM, the private placement memorandum. So what that is, that's the actual offering. That's the official offering. That's going to include all the disclosures, all the legal disclosures, all the risks associated with the asset or the subject property. So that's the formal offering, right? Cap rate. So this is something you'll hear a lot. So what cap rate is it gives you an indication of what the return on the property would be if you paid 100% cash. So if it's a 5 cap, that means if you paid all cash, you took no debt, you get about 5% return per year, right? So that's what the cap rate is. And the way we use that is it allows us to also compare kind of apples to apples, but every market is going to have kind of its own market cap rate. So some of the high cost markets like LA, San Francisco, they could be trading at a 4 cap. So the lower the cap rate, the higher the price of the property, right? So the way we calculate cap rate is you take the net operating income and you divide it by the purchase price. So you're often comparing what your purchase cap rate is to the market cap rate. But we also use that as part of our pro forma, part of our projections for the sale. And then equity multiple that's just another way of saying your total return. So usually it's the way it's presented is with the number with an X after it. So it'll be a 2X equity multiple. So that just means you're doubling your money. If it's a 3X, you're tripling your money. So you put down $100,000 and it's a 2.5X equity multiple. That means you're getting back your 100,000 plus 150,000 in profit, right? So you just take your initial investment, you multiply it by the equity multiple. That's your total return. Easy peasy. All right. So now you've got that done. You got that down. You're an expert on the terms, the lingo. But the first step really is to know your goals. So everyone's different, okay? If you're already a multimillionaire, maybe your primary goal is to preserve your capital. You don't want to lose it. You don't want to put it in risky assets. So if your primary goal is preservation of capital, it's going to help drive your investment criteria is what your goal is, right? So preservation of capital, maybe you're investing in Class A assets. The return might be smaller, but it's a little bit more safe and stable than something that requires a heavy lift, right? Cash flow. A lot of people, their primary thing that they look for is high cash flowing properties. So maybe that's for someone that's in retirement and they want to live off the cash flow of these properties. They're going to prefer those assets like value add multifamily that kick off higher cash flow. And there's some deals out there that it's pretty much all cash flow and no equity growth, right? So typically your Midwestern markets maybe have higher cash flow but less appreciation than your coastal markets, for example. And then the other side of that is equity growth. So if you're chasing equity growth, you might be looking at those higher appreciation markets, maybe Sacramento or similar markets, right? And then the tax pennies, like I said, you want to stiff arm Uncle Sam. So there's a lot of people that they have a tax, they have a bunch of capital gains coming in or something. So they need to find a property so they can use the depreciation to write it off. So it's a great technique. So now you've done that. The next step, you got to find a sponsor. So this actually comes before finding the deal. A lot of people don't think this. They think, okay, I have a need. I need to find a deal. And they go out looking for deals. The problem with that is now you're doing two things at once. You're looking at a deal and trying to vet the deal, but you're also trying to vet the operator. And both of those things take time, right? And it's tough to vet an operator in a short time frame. You got to, typically we say there's like a triad. You got to know, like, and trust someone to invest with them, right? And that takes a little time. And you're going to find that, hey, some people you don't want to invest with. Some people have their own criteria of what they look for in an operator. Some people, they want to invest with someone that they want to have a beer with, and other people don't care about that. They just want them to be, super smart and whatever. Some people are more data driven or have a specific strategy or chase a specific asset class. Every operator is different. Every operator has their own strategy. So you got to find someone that aligns with you, right? And your values and things like that. So your network is your net worth. That's how you find sponsors. You network, you get referrals from people. There's tons of sponsors on Facebook that are putting out webinars like this. I mean, I enjoy this stuff, but obviously it's an opportunity for me to talk about myself and my company and get people to eventually invest in my deals, right? So there's a lot of people putting out content. And then, like I said, referrals, meetups, things like that. All right. So how do you avoid getting with a bad operator? What are the red flags? What are the landmines you want to avoid? So here's kind of my top ones that I recommend. So number one, moonlighters. So there's a lot of people out there that are like part-time sponsors. They got a day job, they're an engineer or a doctor or whatever. And then at night they're doing multifamily investments, which nothing wrong with that necessarily. I'm not saying people that do that are bad, but I would say make sure that there's someone on the team that is doing it full time, right? Somebody that, is a co-sponsor that has some authority within the group that is doing it full time. So that way, if the building's on fire, they're getting the call and they're not stuck in a meeting and can't answer their phone or whatever, right? So I think, also when things go bad and times are tough, if it comes down to them focusing on their day job, which is providing their income, or focusing their efforts on your investment property, that's a tough call for them to make. So you want to make sure that they're in the proper position to be a fiduciary for you and make sure that they're taking care of your investment, right? Along with that, make sure they have skin in the game. So they should be investing in the deal as well, right? Now with this, everyone has different philosophies. I would say make sure they're at least putting the minimum. Ideally, they're putting more, but talk to them, and they should be transparent with this because, hey, I've only been doing this a year. I don't have millions of dollars sitting aside where I can put in $1 million every property, right? So at a certain point, I do have to take my liquidity into account and look ahead at, the next 2 or 3 deals as well, because I don't want to run out of money and can't do a deal because I don't have any money to put skin in the game, if that makes sense, right? So, but just be transparent. They should be transparent with you and sharing how much they're investing. And maybe they don't know an exact number because maybe they're willing to go up to 10% to make up for some capital raise shortfall, but they should have their bottom dollar in mind. All right, this one. So this one is, I would say, rare. I don't think I see it a lot, but it would be a big one to look for is, are distributions a return of capital? that you want to be concerned about. If it's a return on capital, that means it's a profit, right? That's your cash flow. That's your cash on cash return. It's a return of capital. That means that it's just paying down your capital account balance, right? It's returning your equity to you. So you want to make sure your distributions are return on capital, not return of. The exception would be refis. Typically is a good example of a return of capital. That's when you're getting a portion of your investment back. It's not considered profit, right? So just some of those distinctions, and it could be easy to miss. So overall, what's your gut tell you? Do they fail the gut test? That's a big one. I think, people, you gotta trust your gut. You gotta trust your instincts. If someone comes off and, you get a little feeling that they're maybe a little slimy or kind of a used car salesman, maybe pass on that. You want to make sure you're comfortable and you trust the person you're investing with. You also want to make sure your interests are aligned with the sponsor. Basically, how you do that is you want to make sure that they're making most of their money at the end of the deal on the sale. So there's always going to be fees. You're always going to have an acquisition fee. Typically, it's going to be about 3%. If it's a development deal, maybe it's 5 or 7%. But so there's always going to be fees. Don't be afraid of fees, but you just want to make sure it's not fee heavy. If you see an acquisition fee at 3%, a 3% asset management fee, and a disposition fee at 3%, now you're saying, well, hold on, you can sell this thing break even and still walk away with $500,000 or whatever it is, right? So you just want to look at that and make sure that their incentive, their motivation is aligned with your best interests, right? And then pref paid with the reserves. This is something I've heard about. It's kind of concerning, is operators that overraise so that they can pay the pref from day one, basically. But they're basically paying you with your own money. So that doesn't make sense to me, and it's kind of concerning. I think, look, if you're going to be a partner in a deal, sometimes you got to accept that certain deals don't cash flow on day one. That's not a bad thing. Doesn't mean it's a bad deal. You might not earn distributions for the first 6 months because they have to, maybe there's down units that they need to fix up. Maybe there's a management issue with low vacancy or high vacancy. But if they're paying a pref with reserves, I'd just be a little concerned with that. I think sometimes people put too much emphasis on having a pref. I don't think it's always necessary, or necessarily means that you're getting a better deal. Often there's a give take situation. So if you're given a pref, maybe you'll get less equity opportunities. So you kind of got to weigh that a bit. All right. So you found some operators you like. Now what? Well, they're going to send you a deal at some point. So once you get a deal, what do? Well, start big to small. Keep it big picture. What's the story of this deal? Where did it come from? Why is it being sold? Just kind of basic questions. Just give me the broad strokes of the deal, and that'll lead you down to where the opportunity is, right? So what is the opportunity within this deal that makes it attractive as an investment? Is there a management play? Is there opportunity to do renovations? What's the potential profit? Where is it coming from, right? And some deals don't really have one. If it's like a turnkey Class A type investment, okay, you don't have the opportunity to renovate because it's already got granite countertops and stainless steel appliances, right? So maybe with that type of deal, it is just, hey, we're going to get, 7% cash flow on year one, and then we're going to hold through year 10. And by the end of the deal, it's going to average 9-10% cash on cash. And, here's the equity multiple. That's fine. But you just want to know what that is going in. And then what's the market? If it's urban, suburban, if you're looking at a building of studios, maybe that works in urban core, but not a suburban environment, right? So what type of market it is in, before you are given the actual offering, usually it's given through a webinar, and then, like I said, the PPM, but usually there's going to be some emails leading up to that. So it's going to have some basic info. What market is it? You can start to do a little bit of market research and figure out, is this somewhere I even want my money to be? Is it a growth market? Do they have population growth, job growth? Or is it in Detroit where they're losing population? Maybe you don't want to be there, Cleveland or something, All right. And then here's some critical questions to help as a good jumping off point. These are questions that should pretty much always be answered. And if they're not answered in the webinar, then that in itself is probably a red flag to watch out for, right? So what's the asset class? Again, going back to what your criteria is it multifamily? Is it industrial? Is it medical office? What's the asset class, and does it align with your goals? How big is it? Is it a 10-unit apartment building, or is it a 100-unit? 100-unit, you can have an on-site property manager and a maintenance guy. It's going to be scalable. It's going to be a little more secure, a little more stable, right? When's the exit? When am I going to get my money back if I invest in this deal, right? So some projects have a 3-year timeline, some a 5, some a 10. So you want to know that. And then when you look at your returns, you take that into account. So you look at what's the total return. So if you're getting 100% return, well, that sounds great. But if it's on a 10-year timeline, that's annualized return. That's a 10% return, right? So that's where you're kind of looking at your returns, and you're going to compare it to the timeline those come on. So what's the internal rate of return? Are we getting cash flow, or is it all at the end of the deal and you're going to have a lower IRR? And maybe there's another opportunity that has a higher IRR that should factor into your equation, right? What's the loan type? Is this long-term fixed rate debt, or is it a bridge loan with a floating rate? What are the terms? Is there a floor or a ceiling on the rate? How long is the loan? Is it interest only? All the kind of factors of the loan that you're going to want to look at. What's the exit cap? This is probably, if there's one thing that I would stress, it's what is that exit cap? I think that if there's anything that really moves the needle on an investment pro forma, it's the exit cap. The debt too, but the exit cap can really move it. Just a small adjustment to the cap rate can have a huge effect on the value of the property, right? So that's a big one. We'll talk some more on a future slide. What's the expense ratio? What are the vacancy assumptions? What are the rent growth assumptions? These are all questions that you should be asking and should have answers to. So Keegan, these are great questions, but what should the answers be, right? What do you want them to be? All right, so here's some benchmarks, okay? So credit where credit's due. I stole most of this from the Good Egg Investments. So shout out to Julie and Annie over there. They had a great product like this, but I changed it a bit to my own philosophy and added a couple things. So let's take a look. So I have it broken down with your kind of less ideal, you're good, and you're great. So asset class, if it's a class D, if it's like a war zone property, probably want to stay away from that, okay? You really got to know what you're doing and what you're getting into with that type of asset class, and very few operators are equipped to handle that, I would say. You know, it's a specialty in itself. If it's a class A, it's probably a good investment, but it's not going to achieve the returns that a B or a C value add will, right? So that's why those are typically I'd classify as great opportunities. Number of units, if it's less than 50, you're not having good scalability. 50 to 100 is okay, but really it's when you get to 100 plus, that's when you have on-site management, and that's when it really scales and those economy scales start to be seen. Your equity multiple. So this is, and these numbers for the equity multiple, I'm thinking on a 5-year timeline, because that's kind of typical. I would say right now in the industries, you tend to see things presented on a 5-year timeline. So over 5 years, if it's less than 1.5, it's not that great. Somewhere between that and like 1.85, it's pretty decent. You know, if it's over 1.85, I think that's pretty solid. Most syndicators, I think, their goal is to basically double your money within 5 years. So if they're presenting you something less than 1.5x, I don't know. I think there's better opportunities out there, right? But, you know, maybe it's 1.85, but if they're being conservative, there could be additional upside there as well, right? So along those lines, internal rate of return, so less than 13%. Again, I think there's better opportunities out there. Good investments, you know, typically, you know, 14, 15% IRR is pretty good deals. Anything over 16, 17% is pretty great. Cash on cash, less than 5%. I wouldn't be particularly interested in it. Maybe there's certain scenarios where you're chasing appreciation somehow, but you know, if you're looking at multifamily, I think, you know, 6-7% is pretty achievable for most investments. Anything over 8% to me, I think is a good cash on cash. And cash on cash will change over the life of the deal. So every year it should improve. Just keep that in mind as well. Loan type. Is it a recourse loan? So recourse just means that they can go after the people that sign on the loan, the guarantors, they can go after them personally. But it's non-recourse. Their only recourse as the lender is to take back the property. So that's all that means. Pretty much commercial. It's pretty much always non-recourse. But is it bridge debt or is it agency debt? If it's bridge debt, that's fine as long as they have a reason, right? So the Houston opportunity I mentioned, we're using bridge debt, but the reason is we're able to fund our capital expenditures. So $1.4 million that we're able to get from the lender. And it also cuts down our requirements for reserves because of COVID. Agency loans are requiring 9 or 12 months of debt reserves plus insurance and taxes set aside. So it becomes very difficult to operate with those restrictions, right? Same thing with loan term. Typically, you're going to see 5, 7, 10-year terms. So what it is with commercial loans, they're going to amortize it out to 25 or 30 years, but typically your term is a lot shorter, so you have a balloon payment. So again, if it's less than 5 years, that's not necessarily a problem as long as they have a reason, right? But just realize that if they don't have extensions worked in and things like that, that's where it could get riskier. All right, exit caps. So this is a big one. So if it's equal to or less than the entry cap or the market cap, then that's where I'd be concerned. They're assuming there's going to be cap rate compression, especially in today's environment. We have very low cap rates. That would be a non-starter for me. They should be expanding the cap rate for the exit assumption. So they should be adding at least 25 to 50 basis points above the entry cap or the market cap, ideally more than 50 basis points. Okay, so, my Houston opportunity, we're underwriting with an exit cap of 6.75%. The market cap in Houston is like 5.25, 5.5, depending. So that's where you can see that they're being conservative. And that should give you that warm fuzzy that they're not underwriting with unrealistic expectations, okay? Rent comps. Are they assuming that the new rent is going to be the market leader? Are they assuming that they're going to be best in class and, hey, we're going to match or beat the market leaders? Or are they assuming they're going to come in below that, right? I would want to see, $50, $75 below the higher competitors, ideally a few people higher on the projections, not just the in place, but the projections. They shouldn't be assuming that they're going to be at the top of the market is the bottom line. So that's different than rent growth. Rent growth is your year over year rent growth on the underwriting. And when it comes to that, if I'm seeing, 4 or 5%, that's a big concern because again, they're assuming best case scenario, right? There's maybe 3%. I think you could justify in certain markets that are high growth, and 3% could be justified. But 2% is probably your most conservative, right? Because it's basically keeping up with inflation. So if they're underwriting with 2% rent growth, I'd feel very comfortable. Vacancy. Less than 5% is a red flag to me. I actually had a buddy send me a deal a couple months ago. He sent an offering by someone. He said, hey, I don't really know what I'm looking at. Can you take a look at this and tell me if this is a good deal? And that was one of the things that jumped out to me was they had vacancy at like 3% in their projections. Well, that's fully occupied. When you get 100 plus units, you always have turnover, right? Even like 50 units. So it's unrealistic. You're never going to have 100% occupied. It should be at least 5%, ideally more like 8 or 10%, right? And, everyone has kind of different ways of accounting for this. Some people might have 5% vacancy and then 2% what's called loss to lease. And there's some other things in there. But you basically want them to be adjusting the gross potential rent collections down by 8 to 10% is your ideal. So those are some helpful benchmarks just to kind of gauge what you're looking for when you're looking at these offerings. All right, and then here's, like I said, the kind of primary 4 things that I look at. And what's great about these, I think, is they just give you insight into the philosophy of the operator, of the underwriter. How do they think about underwriting and kind of what goes into it. So I already talked a bit about, rent growth, but again, you want it to be below the market rates. I will just say as a caveat, your first year, if it's a value add deal, you might say, oh, they're bumping the rent, 8% in that first year or whatever it is. Well, that's because you're fixing up, you're renovating units. So your income is going to increase because now you've got units coming online at a higher market rate, if that makes sense, right? So that's not necessarily what I'm talking about. What I'm talking about is, after when you're looking at especially years 3 through 5, is that's where they should be conservative with, 2, maybe 3% on the high end for their rent growth assumptions. And they should also be increasing expenses along with that. And then again, vacancy, like I said, you want to see kind of 8 to 10%. Expense ratio. So typically I would say a value add, the kind of rule of thumb is 50%. And then operators are looking to, compress that down to maybe, 45% or something. So if you're within plus or minus 5, okay, they're doing pretty good. If you're looking at a value add and it's underwritten for, a pro forma 40% expense ratio, that's where you maybe start asking some questions. I'd say my thought on expenses is, I've had some investors ask for the actual underwriting. Hey, send me the spreadsheets and things like that. And let me tell you why often sponsors are hesitant to give you that information. So even though I do this for a living, if I look at somebody else's spreadsheet, it takes me a while to figure out, okay, what were they doing? How did they move the needle on this spreadsheet? What are their assumptions? What's their kind of philosophy, right? And it can be tricky. And sometimes you think you caught something that they screwed up or something, but they have a reason. They have a justification for it. So not everyone is going to be, or really no one should be, hyper conservative on every aspect. So not every one of their expenses should be, assuming it's going to be 10,000 more than the seller, because they're maybe accounting for it in there. Maybe they put a high vacancy rate or a high exit cap. So everyone's going to have their own methods of being conservative. And if you're ultra conservative across the board with everything, you're never going to get a deal, right? Because it's never going to pencil out. So that's why I think a lot of people, they're hesitant to send those spreadsheets out to people, the raw data, because it's really easy to kind of get confused and lost in it and misunderstand it. And then an investor, they have the wrong assumption or the wrong understanding of it, but they just never pursue it because they think they understand it when they don't, or they can start playing around with things like the exit cap, put in a 5 cap, and suddenly they think they're going to be a millionaire and they go in with unrealistic expectations. That's not good either, right? So we kind of want to manage those expectations. Usually your syndicators, what they're presenting to you is not kind of what their internal expectation is for the property. They might expect 10% cash flow, but they'll present you 8%, right? So that's why they don't want to give you those spreadsheets, because it can leave people with unrealistic expectations or misunderstandings. So, all right. And like I said, exit cap. So again, 50 to 100 basis points above what the entry cap rate or the market cap rate upon entry. Because sometimes you're buying a distressed asset or a value add that on paper it's below market, but that's because there's a lot of value potential, right? So that's where some of that gets worked in. All right, so that's the formal portion. So if you guys have any questions, please go ahead and shoot those into the chat box or the Q&A box, and we can discuss those. If you're interested, if you haven't reached out to me yet, you can find me at mach1equity.com/take-action. And there'll be an investor questionnaire. You can kind of fill out some basic info about yourself and it'll connect us. So if you have any questions, you can also email me. I'm at keegan@mach1equity.com. So, all right, let's take a look. I'm going to stop screen sharing and take a look at some questions. All right, Steve is asking, if inflation comes, rent should rise, but will cap rates go up as well? So yeah, typically your rents and your property values are going to track with inflation. But let's see, will cap rates go up? Typically, I think the thing that moves the needle on cap rates the most is going to be your interest rates. So that I would say is the thing that moves it the most. Also, just general demand, right? So we have a lot of money flowing into multifamily because of what I said about its stability, its safety. So there's a lot of big money interests that are moving capital into real estate, and that's increasing demand, and that's going to help drive down those cap rates. Like I said, right now we have low interest rates, so that's probably the biggest thing that's going to move cap rates. Is if we see interest rates rise in the future, then we'll likely see some cap rate expansion. Now, what's the likelihood of that? I think it's very unlikely in the next maybe 2 years, because we're at 0%. The Fed's been pretty clear they're not going to touch it this year. Even if they add 100 basis points the year after, or 200 basis points, well, okay, we go from 0 to 2%. It's not like this drastic move. It will probably expand cap rates a little bit, but it probably won't be drastic. But I think overall, the general consensus throughout the industry is that if anything, in the short term, a lot of people think cap rates could compress, but people aren't expecting a lot of cap rate compression. I think the demand is there, and people are chasing yield, and that's where they're getting it. And like I said, the institutions can't get it through treasuries. So, all right. What are the typical fees? Okay, maybe I probably should have made a slide for the typical fees. So here's your typical fee. So the big one is acquisition fee. So acquisition fee is paid to the sponsorship team upon closing the property, and that's their compensation for all the work up to that point, right? All the schmoozing with brokers and banging out on the phones and all the underwriting and due diligence and everything that is required to get that thing to close, raising the money, everything. That's the compensation, right? Is the acquisition fee. So that's typically you're going to see, 2 to 3% on that. If it's a new development deal, usually it's 5% is your acquisition fee. Now the other one is a asset management fee. So this is paid to the asset manager or the sponsorship throughout the deal. So it comes off the gross effective rent. So it's usually 1 to 3%. So overall, it tends up being almost a negligible amount of money sometimes, but certainly something you should be aware of. If it's 5%, that's where you got to be concerned. But usually you're seeing about a 2% asset management fee. Sometimes you'll see a capital event fee. So capital event fee would be a fee collected upon a successful refinance. So I can tell you the way we're doing the refinance on Glen Oaks, my Houston property, is so 100% of the refinance goes to the LPs, goes to the investors, because it's a return of capital. So we're not pulling, even though that particular deal is 80-20, 80% of the equity for investors, 20% for the GP. 100% of it goes to the investors, less I think it's a 3% capital event fee. So there's that fee that goes to the sponsorship, but the rest of it, 100% goes to the investors. So, that one will vary 1 to 3%. And then another one would be a disposition fee. So disposition fee is kind of the opposite of the acquisition fee. It's upon the sale of the property, fee paid to the sponsor. So that's the one that personally I'm especially looking for. I mean, with all these fees, let's say they have all of them, if they're all maxed out at like 3%, which is kind of the industry average, I would say, that's where I'm like, okay, they're very fee heavy. If they have like a 3% acquisition fee and then the rest of the fees are at 1%, then okay, yeah, they have fees at every step of the way, but they're small in comparison, right? So that's kind of how I view that. I think the disposition fee is probably the one you see least often, because a sponsor is making their money on the sale. They're making their money off the equity that they hold in the property. That's their sweat equity, right? They're doing all this work for that equity upon sale. So they're also getting a fee. The concern is that they could sell the property for break even and then still make $500,000 or whatever, right? So you don't want that because that's a misalignment of interest, but that's pretty typical. All right, let's see what else we got. What's my take on buying a foreclosure single family home with cash, flipping and renting? I don't know. You're seeing a lot of foreclosures out there right now? Unlikely. There's forbearance right now. So most people that are in trouble can't pay their mortgage. They have forbearance opportunities. And largely the big difference between right now versus 2008, for example, is 2008, homeowners were underwater. They lost 50% of homeowner equity was wiped out between 2006 and 2008. So when 2008 happened, all these people were underwater on their mortgage. So it didn't make sense for them to sell the home at a loss because they're still in the whole 60 grand that they got to pay the bank. So they just stay in it and let it foreclose. Now it's a bit different. People have the opportunity to sell their home. It's a seller's market out there, right? People getting 30 offers a home in 2 minutes. So they can just hold on until the forbearance runs out and sell their property. And you're probably not going to see a lot of foreclosures. I mean, I'm sure there will be some, there's always some, but I don't know. It just sounds like probably not where the most opportunity is. Personally, I like multifamily. I don't mess around with single family. You can't scale it. You're doing the same amount of work for inferior asset. Multifamily is superior in every way. The big thing that makes multifamily superior is we control the value of the property. So as we move the net operating income up, this is where the cap rate comes into. So the value of the property generally is you take your cap rate is your net operating income divided by your property value, right? So as net operating income goes up, so too does the value of the property, right? So you take your NOI and you divide it by the cap rate, gets you your potential sales price, right? So that's how that projection works. So, it's like, I think I have to do the math on a 100-unit apartment building, for instance. If you raise the rent by $25 and it's a 6 cap, I think it ends up being like $400,000 in value or something. So you can make small changes at the property level that have outsized changes to the property value. And that's why multifamily is superior, because we can actually move the lever. I just acquired my first deal, duplex house hack, using a VA loan. Nice. That's what I did. VA loan. It's awesome. Actually, I have 2 VA loans. What is the best way to get the second property? I don't know. How much do you have entitlement left in your VA loan, or you're maxed out? That's the first thing I would ask you. If you have entitlement left, I would do another VA loan. 0 money down. As an LP investor, do you think cash on cash is better metric than IRR? I think that they're telling you 2 different things. So your cash on cash is going to tell you your yearly profit in distributions and dividends, right? So if you invest, let's say you invest $100,000 into a project that has 8% cash on cash, that means you're getting $8,000 a year in cash flow. So every quarter you're going to get a check for like $2,000, right? IRR is looking at the deal as a whole while accounting for time. So your IRR might be, it's similar to your annualized return. The difference is if there's cash flow involved earlier in the life cycle of the deal, it assumes that you can reinvest that money to compound your return, right? So that's one of the advantages of cash flow, is that you don't have to spend that money. Put that into the markets and let it grow. And, if you're earning $8,000 a year off of cash flow, you can put all the cash flow into an investment account. And when it hits 50K, now you got another share in a syndication and you just leveled up, right? Without any of your own money. Or if you're already saving on your own for investments, now it just speeds up that whole process, right? So that's why cash flow is great, and it lowers your risk because you're getting money up front, right? So IRR, it's a confusing thing. So that's why most people, it's easier just to look at your annualized return, your total return, and your cash on cash. Then I'll kind of build your picture. All right. what percent do you pro forma for expenses if property is performing already? Yeah, 50% is kind of your going in argument. If it's, say, a turnkey property, so it's really nice, it doesn't have any value add, it's, a newer property, maybe it's operating in low 40s, 40%, 41% or something. I've never been involved in a new construction development deal, but from what I've seen, I think it's like, maybe 33, 35% is the pro forma upon completion. So the nicer the property, the lower it is, just because your maintenance is going to be lower, right? So a value add property might be accounting for $500, $700 a year per unit in maintenance expense. Whereas a new construction, you're probably not going to have that expense, right? Stuff shouldn't be breaking. If it does, get a new developer, I guess. Typical equity split. That's a good question. So typical, I would say right now is 70-30 is what you see a lot. So that means 70% of the equity goes to the LP, the investors, and then 30% goes to the general partners. Okay. And that's their sweat equity, right? But that's, I would say, commonplace, typical, but by no means does it have to be that. It could be 80-20. That's fine. It's 60-40. It could be 50-50. Doesn't really matter. I've seen deals that are the other direction where you got 65 for the GP, 35 for the investors. But if you're earning 30%, what do you care? What do you care if you only own 5% of the deal, right? So it's important. You should be aware of it, but it's not, you shouldn't have a line in the sand, I guess, because I've seen people pass on investments and they say, oh, well, they're taking 40% of the equity. This other guy's only taking 30. It's like, yeah, but that guy's deal is better. That's why he can take, because look, for a lot of syndicators, the mindset is sometimes you'll have a deal that maybe isn't a grand slam. It's not a home run deal. Maybe it's a solid double or triple. So you can say, okay, I can give them more equity. I'll give them 80% equity. That way I can give them their expected returns. They want kind of 8% cash on cash, or, doubling their money in 5 years. And they'll take a smaller piece of that pie because they want to maintain deal flow. They want to maintain the relationship with their investors. But in their back of their mind, they're hoping, hey, down the line, if I have a grand slam, then I can do a 60-40, still get them a great return, and then I can, get a nice windfall for myself. There's nothing wrong with it. You shouldn't be afraid of people making money. That's how the whole industry operates, right? Syndicators need to make their end of it, right? So, but 70-30 is kind of I will say this as a caveat. If you see like a 90-10 deal, I would say if you're going to have a line in the sand, it's the other way. It's 80-20 is probably the most I want to see the LP have. And here's why. If you see a deal that's 90-10 in favor of the investors, that means it's a very thin deal. There's not a lot there, right? So they had to go all the way to 90-10 to make it work, where an investor wasn't going to dismiss it out of hand just off of the cash on cash or whatever the case may be, right? So I have heard horror stories of people that are they're new or whatever, and they're trying to just get a deal, so they just they basically overpay for a property, and then they do a 90-10 split in the hopes that they can just kind of get their foot in the door and get off the ground. So that could be concerning. All right. I think that's it. Any more questions? All right, guys. Well, thank you guys for attending. Appreciate you guys taking time out of your week to listen to me rant on here. I hope you guys learned something. Definitely check me out at, like I said, mach1equity.com/takeaction. You can go on there and fill out an investor questionnaire, and that'll connect us. Let me know what content you guys want. If there's a topic you want covered and you don't see it anywhere, let me know. That helps me, helps me from having to come up with ideas, right? I'm just kind of spitballing most of the time and going as I go. So if there's a topic that you want to see presented on, let me know. And otherwise, thank you again. Catch you guys on the flip side, all right?